Good day, fellow investors. The new discussion is all about tariffs after this weekend, and in my opinion, tariffs are here to divert attention from something else. It is just a short-term political thing. Every politician has the right to do his own ideas, but there are also short-term and long-term consequences of imposing tariffs. Let's discuss the three key factors I see: full employment, tech leadership, and then likely, after the promises have been completed from elections, perhaps subduing when the costs arise. So if we look at the US economy, it doesn't need much growth. It has been growing at 2.53% for the last few years. Consumer spending is doing great, everything looks good. And recently also there has been a strong US jobs report, thus you don't really need those manufacturing jobs that are promised by being there with tariffs. The unemployment rate is still at a natural unemployment rate, which means there is enough employment, and the US has been the tech leader and is the tech leader out there globally. And if you look at the top companies globally from a market capitalization perspective, we have Apple, Microsoft, Nvidia, Alphabet, Amazon. Only Saudi Aramco and TSMC are not from the US. So look at the leadership there from the US compared to manufacturing. So here is what it's looked like to work at a giant Apple iPhone factory in China. So there are tech benefits and there is manufacturing. This allows for this. And now playing around with tariffs might even change the structure of American global technological leadership, because this is not something I see happening in America that fast. So now we have the tariffs, 10% here, 25% here. Okay, it is what it is from an investing perspective, but there will be a cost on it, not only on the exporting countries, but also on the importing countries. These costs, this additional global cost we have seen, retaliation, will be paid by likely everyone. And therefore it is a very difficult thing to balance inflation, tariffs, taxes, growth, deficits, interest rates. And as soon as you add an additional cost there is benefit to cheap production in the world, there are costs always, but focusing on just one thing doesn't really balance things out. So it's possible that we have slower growth going forward globally and higher inflation because of the additional costs on top. And if we look at components of GDP growth for the United States of America, the key here for the last few years has been consumption. And now consumption will likely be hit with tariffs. It's not that the exporters will pay. Depending on the thing you are buying, we will see where and how the tariffs will impact the prices going forward. But let's look at all industry excluding tech investments, thus manufacturing, has been flat relatively in the United States for the last decade. If we look at communication equipment, computers, semiconductors, that is where the US has been investing, which makes things again different. And look at the capex expected from those leading companies in the world, billions and billions, not into manufacturing with cheap labor. So the question is now, will the US focus on cheap manufacturing, or it will continue to focus on being the global leader, technology, army, dollar, currency? That is always something to balance, and we will only see the repercussions of these tariffs over the next few years. For now, it's all just media, just discussions. We will see the real impact in the next few years, both the positive and the negative. And perhaps these tariffs are just there to divert the media from this. Net interest costs from the budget 1 trillion or 15% of total spending. But If we look at this from total government income, that's 25%. That is huge, is just on interest rates. Now, with inflation, if there is inflation from tariffs, the Fed will not be able to lower rate, which means these costs might even go higher and therefore be counterproductive for all the measures. So we will see how will this work, but this is the key. This deficit is the key cost of the US government, and by discussing tariffs that are just a small rounding error here, you divert the focus from the elephant in the room. The long-term cost to US consumer global growth will be seen, but when it comes to investing, short-term, long-term, that's all something that we'll see how it evolves. My key conclusion is, if you invest with a P ratio of 10 and let's say 10% growth expected, that you can find businesses globally, it's much different than investing with P ratio of 30 on, let's say, 7% or 10% growth expected. Tariffs and shocks can impact these businesses much more than these businesses. This is, again, value investing, no matter what the tariffs are, interest rates that we will discuss tomorrow, because that was the topic from Wednesday last week. No matter what happens, we try to build portfolios so that we keep on compounding no matter what the political decisions, political impacts and political costs are. Predicting how will what impact where, how will those balances align over time is practically impossible. Next month we'll be discussing something else and things will roll again going forward. So that's it. I think that with tariffs there will be positives, there will be negatives. The real costs and benefits will be seen over the next few years when there will be discussions already about something else. So the short-term mind of the market, of the media, will already talk about something else when real costs come. That is how it works. We just focus on our investing. See you tomorrow. We'll discuss another key topic from last week, but very important, which is interest rates.